Welcome to the Deep Dive. We're here to unpack complex financial ideas and, well, make them genuinely useful for you. Today, it's all about business insurance. And instead of just definitions, let's start with a scenario, something, quite vivid from our research. Imagine this great little coffee shop, really thriving, built up over years. Then boom, rainy day, someone slips near the entrance, serious injury. Suddenly, there's this huge lawsuit, millions. And just like that, without the right insurance, that dream business is facing potential bankruptcy. So yeah, we really need to see insurance not just as some cost, but more like a financial shield. It's what lets you survive those big hits.
That's exactly it. And our mission today really is to get you thinking beyond just ticking boxes for compliance. We want to arm you with some, let's say, more strategic thinking. Show you how mastering insurance isn't just about defense, it's actually about optimizing. It can even become an advantage. And, the strategic angle, it starts right at the top with the insurance companies themselves. Think about Warren Buffett. He's always been fascinated by insurance, hasn't he?
Right. The float. I've heard about that. But what exactly is the float? And why is it such a big deal?
Okay, so the float is basically about timing. Insurers get your premium money up front, right? Sometimes years before they might have to pay out a claim. Buffett put it perfectly, something like, it's so much fun because you get the money at the start, and then you find out how much it costs later. And that pool of money, the float, it's not just sitting idle. They invest it, sometimes for decades. So the carriers can make serious money from investments, even if their actual insurance underwriting just breaks even. Understanding that helps you see why some can offer lower prices or invest heavily in certain areas. It's all about using that capital strategically.
That really does change how you look at the whole industry. Okay, so let's get into the basics for a business owner. Our sources call business insurance a suite of policies. What does that mean practically?
It just means it's usually not one single policy. It's a collection tailored to protect against different kinds of financial disaster. Things like, property damage, lawsuits, operations getting shut down. It's the financial safety net. And this whole idea, pooling risk, it's ancient really, goes way back. Think 17th century London, Lloyd's Coffee House. Ship owners would literally gather there and chip in money together to cover the massive risk if one of their ships was lost at sea.
Wow. So the principle hasn't changed much, even if the risks have. We're not worried about sea monsters now, but maybe cyber attacks?
Exactly. The sources are really clear on this. Today's dragons are things like cyber breaches. A single bad attack, if you're not covered, can mean millions lost in downtime, fines, fixing your reputation. Insurance has to keep evolving for these new threats.
And these aren't just theoretical risks, are they?
Not at all. Insurance is fundamentally about shielding you from those black swan events. The rare stuff that just wipes you out if you're unprepared. Look at Hurricane Harvey back in 2017. The data is pretty stark. Businesses in Houston with good insurance, many were back up and running, or at least rebuilding within months. But those without enough coverage, they often faced years of debt. Some just never made it back.
That's the real difference right there. Survival versus collapse. And it's not just disasters, there's the legal side too. Workers' comp.
Oh yeah, workers' comp is mandatory in 49 states? You have to have it.
And lawsuits aren't just for giant corporations. The average settlement for a business lawsuit, according to our sources, is over $50,000. That's a huge hit for most businesses.
Absolutely. You can't just hope it won't happen, which leads to something we really advocate for, the risk audit ritual.
Okay, what's that?
It's simple, really. Once a year, sit down and seriously list your top 5 biggest threats. What could really sink your business? Maybe it's a supply chain break, a data breach, a local recession, whatever it is for you. Then, you meticulously check if your current insurance actually covers those specific things. It turns that boring insurance review into a really focused strategy session.
Right, so the audit tells you what you need to worry about, but then what policies do you actually buy? It can feel overwhelming, especially if you're just starting out.
Totally. The best starting point, especially for smaller businesses, is usually the business owner's policy, the BOP. It's a great package deal and normally bundles 3 key things: general liability, commercial property insurance, and business interruption insurance.
And the sources say bundling like that in the BOP can save you maybe 20-30% compared to buying them separately, often under $700 a year for the basics. That sounds good, but is there a catch? Does bundling ever mean you get weaker coverage somewhere?
That's a really sharp question. Generally, the savings are real. It's more efficient for the insurance company. But the catch is always in the details, the limits, the specific things covered or excluded. A BOP is a fantastic foundation, yes. But if your business has very specific risks, maybe you do manufacturing or you handle large client projects, you might outgrow the basic BOP limits pretty quickly. You've got to read the fine print, especially on what property is covered and how business interruption is calculated.
Okay, that makes sense. So let's dig into those 3 core coverages everyone needs, starting with the big one, general liability.
GL.
Right, GL.
Yeah.
That's your absolute foundation. It handles claims from third parties, anyone outside your company, if they get injured on your premises or if your work damages their property. It can even cover things like accusations of libel or slander coming from your business operations.
The sources used a great example. Your delivery driver accidentally backs into a client's very expensive Ferrari. GL is supposed to cover that kind of oops, right? Usually up to $1 million or more. Exactly that kind of thing. And yeah, limits often start at $1 million. What's surprising is the cost. For that core protection, it's often around like $42 a month on average. Pretty affordable for what it does.
Okay. Second non-negotiable, workers' comp. We mentioned it's mandatory.
Yep. Covers your employees if they get hurt on the job. Medical bills, lost wages. An interesting side note from the research, actually. Workers' comp laws are credited with a huge drop, like 50% in workplace deaths since the 1970s, because it forces businesses to think about safety. Cost-wise, it varies a lot, depends on the job risk, but maybe average $70 per employee per month.
And the third piece of that core bundle, often forgotten until it's too late, business interruption.
This is your lifeline if something forces you to close temporarily. A fire, a major storm, something covered by the policy. This insurance replaces the income you're losing. And crucially, it keeps paying your fixed costs, payroll, rent, loan payments, usually for up to a year. It stops the bleeding when your revenue suddenly goes to zero.
Got it. Okay, so those are the basics. What about more specialized risks? The things GL doesn't cover.
Right. If you provide advice or professional services, think consultants, architects, IT folks, accountants, you absolutely need professional indemnity insurance, also called errors and omissions, or E&O.
Why is that different from GL?
Because GL covers physical damage or injury. E&O covers financial damage caused by your mistakes or bad advice. Like, if your advice causes a client's big deal to collapse, GL won't touch that. E&O is specifically for those professional screw-ups, averages maybe $80 a month.
And in today's world, cyber liability feels like it's moving from nice to have to must have.
Oh, completely. Cyber policies handle the massive costs if you get hacked or hit with ransomware, paying for investigators, notifying customers, credit monitoring, covering the income you lose while you're down. The sources really hit this hard. They cited figures like businesses losing an average of $25,000 a month during a ransomware incident. You need that insurance to cover the immediate cash needed to recover.
Okay, one more critical point before we move on. Home-based businesses, there was a pretty strong warning in the research here.
Yes. This is so important. Your standard homeowner's insurance policy, it barely covers business risks, if at all.
So if a client comes to your house for a meeting and trips on the porch steps,
your homeowner's policy might only pay out a tiny amount for injuries, like $5,000 max. That's nothing in a real lawsuit. You absolutely need to add specific general liability coverage for your business activities. The good news, adding maybe $2 million in GL often costs as little as $30 a month extra. But ignoring it, the sources put it bluntly. Don't let home sweet home become lawsuit hell.
Okay, good warning. So once you know which policies you need, the big question is, how much coverage is enough? What's the Goldilocks amount?
Right, finding that just right level. For liability, a good rule of thumb is to aim for coverage limits that are 1 to 2 times your annual revenue. So a business doing $500,000 a year, you'd want at least $1 million in total liability coverage.
And if you're in a riskier industry,
like construction, then you probably want to double that. Aim for closer to 2x your revenue as a baseline. The potential for large claims is just higher.
Makes sense. And what drives the actual price, the premium you pay?
It's complicated, but 3 main things. First, obvious one, your industry. High-risk stuff like roofing pays way more, maybe double, than low-risk like consulting. It's all based on historical claims data. Second is location. Being in a flood zone or a state known for lots of lawsuits, yeah, that can bump your costs 20% or more.
But there's a third factor, right? Things you can actually control.
Exactly. Risk reducers. Insurance companies reward you for being proactive about safety, things like installing sprinklers, having good security systems, strong cybersecurity measures like multi-factor authentication. Those can earn you real discounts on your premiums. It's a clear win-win.
Okay, and for businesses really wanting to bulletproof themselves against a truly massive claim, there's something called an umbrella policy.
Yes, the umbrella policy. Think of it as an extra layer of liability protection. It sits on top of your main GL or commercial auto policies. If a huge claim exhausts the limits of those primary policies, the umbrella kicks in with an extra $1 million or more. And honestly, it's usually pretty inexpensive for the peace of mind it offers. Maybe just a couple $100 a year for that extra $1 million. It protects against that outlier catastrophic event.
To really figure out if those limits are right, the sources mentioned a great practical tip: scenario storming.
Yeah, I love this one. It's about making it real. Sit down and actually game out potential disasters. What if a fire destroyed all your inventory? What if hackers took down your network for a month? Then try to tally up the real costs, lost sales, payroll you still have to make, replacing equipment, fines, everything. That number tells you pretty quickly if your current insurance limits are actually enough. The advice here is basically, maybe overinsure a bit when you're starting out. You could always adjust it downwards later as you build up your own cash reserves.
Right. Build that buffer. Okay, let's shift gears slightly to lawsuits. Specifically, the costs of defending yourself. Do standard policies like GL cover lawyer fees?
Generally, yes. That's a huge benefit of GL and E&O. They are usually designed to cover the legal cost to defend you against a claim covered by the policy. And believe me, those costs add up fast, even if you ultimately win the case. But there's a catch. Those defense costs usually come out of your total policy limit.
Ah, so the defense can eat into the money available to actually pay a settlement or judgment.
Potentially, yes. Which brings us back to history for a second. Remember Enron, when it collapsed in 2001?
Vaguely, yeah. Huge scandal.
Well, the executives who weren't properly insured, they faced billions with a B in personal legal fees. Wipe them out completely. It's a stark lesson. You can't just hope lawsuits won't happen or won't cost much to fight.
Okay, so standard policies help with defense for covered claims. But what about other legal fights? Things GL doesn't cover.
Exactly. That's where a different, less common policy comes in handy. Legal expense insurance. This is sort of a standalone hero, as the sources called it. Costs maybe $300 to $800 a year. It's designed to cover legal fees for stuff GL and E&O won't touch.
Like what kind of stuff?
Think contract disputes with suppliers, fights over intellectual property, dealing with tricky HR issues, or wrongful termination claims. Everyday business friction that can still lead to expensive legal bills. This policy plugs those gaps.
That sounds incredibly useful. Now, you mentioned defense costs eating into policy limits. There's a key phrase to look for in policies, right?
Yeah.
Something about how costs are handled.
Yes, this is crucial. You need to know if your policy is costs inclusive or costs in addition. It sounds technical, but the difference is huge.
Okay, break that down. Costs inclusive.
Costs inclusive means the lawyer's fees and all the defense spending come directly out of your main coverage limit. So if you have a $1 million policy and spend $200,000 defending the case, you only have $800,000 left to actually pay any damages if you lose.
Wow. Okay. So big legal fees could really drain your actual protection.
Exactly. Which is why costs in addition is the way to go if you can get it.
And that means?
Costs in addition means the defense costs are paid in addition to your policy limit. They float free, so to speak. Your full $1 million limit remains available to pay the actual damages or settlement no matter how much was spent on lawyers.
That's a massive difference. Definitely something to push for when negotiating.
Absolutely. It's a key strategic point.
Okay, so let's say the worst happens. A claim comes in. What's the very first thing a business owner should do? Panic.
Try not to panic. The first call should always be to your insurance broker or agent.
Not directly to the insurance company's claims line.
Preferably not right away. Your broker is your advocate. They understand your policy. They know the process. They can help you understand what's happening, make sure you file correctly, and guide you through it. They're your first line of support. And while we're talking practicalities, we have to mention the COI, the certificate of insurance.
Right, the proof of insurance. Why is that so important?
It's basically your credibility currency. It's that one-page document proving you have active coverage. Serious clients, vendors, landlords, they'll all demand to see a COI before they sign a contract with you.
So you need an easy way to get those issued quickly.
Definitely. Having a smooth process for getting COIs generated is vital for day-to-day business operations and partnerships. Pulling this all together, this deep dive really shows that insurance isn't just a passive expense. It's an active part of managing uncertainty and building resilience. It's like the sources even brought up that movie, The Incredibles.
Huh, really? How does that connect?
Well, the idea was that even superheroes, or maybe especially undervalued heroes like small business owners, need proper coverage to operate effectively and, well, shine without fear of getting sued into oblivion.
I like that. Okay, so to wrap this up and make it actionable, what are the key takeaways? The ninja moves.
2 big ones for staying sharp. First, shop around for your insurance rates early, like 2 or 3 months before your current policy renews. Gives you time and leverage.
Don't wait until the last minute.
Exactly. And second, make the annual renewal ritual happen. About 90 days before renewal, sit down and really review your coverage. Has your business grown, changed, gotten new equipment, adopted new tech? You need to tweak your insurance so it actually matches your current risk profile, not where you were a year ago.
That proactive approach again, keeping the shield polished, basically.
That's the goal. Constant optimization. It's how you move from just surviving risks to actually thriving despite them.
Okay, so final thought, looking ahead. Our sources threw out something intriguing about baking AI ethics into E&O insurance. What could that even mean for a business owner right now?
Yeah, that's forward-looking stuff. It suggests that as AI gets deeper into professional work, making diagnoses, giving financial advice, writing code, new kinds of errors and biases could emerge. E&O policies might need to specifically address failures related to AI decision-making or algorithmic bias. Wow.
So the provocative question for you, the listener, is what other novel risks, maybe from AI, maybe from climate change impacts, maybe something else entirely, what should you start researching now so you can factor it into next year's risk audit? Because building that truly unbreakable fortress means looking over the horizon, not just at today's obvious threats.